Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Jim Edwards, the founder and managing partner of Maestria Partners. Jim spent a number of years working for big university endowments before launching Maestria in 2023. Jim is a fundamental investor at heart who thought deeply about how to differentiate his firm before going out on his own. In this wide-ranging conversation, we discussed Jim's journey from the allocator world to launching his own investment firm, what he learned about differentiation and best practices during his time as an allocator, the types of business models he gravitates toward, his approach to valuing companies that the market already has a deep appreciation for, and why he's chosen to run a pretty concentrated portfolio. Now, without any further ado, here's my conversation with Maestria Partners founder, Jim Edwards. Jim, you and I have known each other for a long time, and I'm familiar with your journey, but I'd love for you to tell listeners about your path from the allocator world to managing a stock portfolio for clients at Maestria.
Yeah, Ben, thanks for having me on the podcast. It's been about 15 years since I think we met. And, I got to give you some praise because you're a true leader in the student fund at UCLA and have since been, a practitioner there in the value investing program. And as your listener knows, you're well read and steeped in history from Berkshire Hathaway all the way through the Daily Journal and Westco Financial. And you had a real impact on people like me who are around you. And so a lot of sort of my journey has been impacted by people like you. So a huge thank you to you for that. For me, starting on the allocator side was never the intention. I grew up sort of a middle-class kid in the Midwest, and I always wanted to be an investor. And coming out of undergrad, just made a wrong turn and was working for a firm that wanted me to sell fee-based financial products that didn't align with what I knew were the right ways to invest. And so I had a long path going through PricewaterhouseCoopers to do bankruptcy restructuring, and then needing to go back through business school to get back to sort of stock picking and investing. And I wound up at the UCLA endowment after they got a new CIO and had an outstanding experience learning that what I'd always thought was the right way to invest was possible. And so for me, sitting at the endowment level gave you a bird's eye view into what the best investors in the world were doing and sort of the right ways to make money for me. And I think that authenticity component is really the nuance to what separates, I think, the good from the great. And a lot of people who grew up on Wall Street, wind up being well aligned to pod shops or private equity firms. I think for me, loving the sort of searching for great businesses that were underappreciated in public markets and really caring deeply about partners came through on the allocator side. And so I understood sort of the 360 Oculus view of all the different participants that make investing challenging and rewarding outside of pure performance or financial metrics. And so for me, it was just a very circuitous route, and through a whole host of luck, wound up getting here, in my early 40s. But I don't take any of it for granted. And as I was just sort of alluding to with Ben before the podcast, I think people like us should have been incentivized to take more risk earlier in our careers. And, for a whole host of reasons, Ben, I think you're on a similar path to me where we've got 20 years more experience, but we've also got some other priorities. So that focus has become a lot more important. But I think we've learned a lot together over the last 15, but really learning from others' mistakes.
Yeah, agreed. You are hyper-focused when you're taking risks, when you have, families and other obligations. So Jim, you mentioned in that response, you kind of learning about what great investing was and sitting across a table from great managers when you worked at UCLA and Emory. So I'm curious if there are any major elements that you saw consistently among the best managers and then wanted that to be part of your firm.
Yeah, let me take you through sort of the backdrop, because at UCLA, working with Srini Pullavarthi, who'd come from Spider Management Company, they had one of the biggest allocations to long-short investing. And me being a public markets investor, sort of in my DNA, that really always resonated with me. but we inherited a large portfolio that the prior consultant-led regime had put together. And so for me, having seen how others do it and then realizing what sort of makes sense for someone who's been successful with a first principles concentrated, fundamental investing approach meant in terms of a holistic change and starting from a clean sheet of paper. And so one of the best things I did was in 2018, he encouraged me to write down what I would do if I were the CIO. And so I put together about a 100-page deck, and it was going through exactly what all the mistakes were, all the lessons, and how I'd do it if it were done differently. And the reality is, if you or I woke up with $10 billion, we probably wouldn't have 130 different managers that we didn't know, pay them a lot of fees to wind up with a portfolio that was highly illiquid that we didn't know what it contained. And so for me, when you study the best and you figure out what's worked and what hasn't, the biggest mistakes are really people paying too much in fees, people chasing returns. They don't understand the risk tolerance. They don't understand the holdings or their strategies, and they over or under diversify. And so, the simple analysis here is if you decompose Berkshire's returns and you layer on 2 and 20, the reality is that limited partner winds up with about 10% of the returns. And it's just that fee drag is so pronounced over time. Even if the outstanding, multiple of returns is wonderful, over long periods of time, the management fee and incentive fee really do degrade the economics and the alignment. And so for people like us as an endowment with a really long time horizon and a cost of capital of about 8 to 10%, just owning great businesses seemed like the right approach. And so, once you started digging through sort of some of the governance nuances to why don't more people invest the way Berkshire does, or why don't they remove all these different layers of friction between a company CEO and their investor relations, and then an analyst and a PM at a hedge fund, all the way through the stakeholders at these endowments and foundations. And the reality is there's a whole host of sort of alignment that comes through and makes people feel comfortable committing these sins that I outlined in terms of fees and chasing returns. And so for us and for me, just wanting to reduce as many layers of friction as possible to get to just owning what I thought were sort of really the best businesses in the world that could fulfill that objective. And so had a real sort of sounding board there with UCLA and then at Emory, because Emory's investment committee had really come from this first principles mindset of holding Coca-Cola stock for 30 plus years. And so that's a really unique sort of backdrop for someone like me on the allocator side, having learned some of the lessons from the best investors in the world. And that's sort of why I named the firm Maestria, which is mastery or learning from the masters of the investment world. And Money Masters is a book when I was younger. Like Warren Buffett basically broke down all of his principles, and they're sort of unimpeachable. They're still there today, but it was written in 1980. And so for someone like you and I, Ben, like that ultimately becomes sort of foundational in how you think. And then if you study some of the other world's best investors, so Magnus Engenfeld put together the 99 world's best investors. It's probably 15 years ago at this point. And he studied them. And what ultimately came about from this book of studying the best investors is they stick to their principles in the short term and they evolve in the long term, right? And he says, this is perhaps the single most important lesson to be learned from studying the best investors. And I ultimately came away thinking that was a foundational principle as well. So you kind of want to study the best businesses in the world and have a real understanding of how you think about expected returns and valuation and really understand risk, because it is about survivability. And so for you and I, maybe that would have lent itself historically to holding more cash. But when you go through all the data, you realize a fully invested long-only portfolio of great businesses is the best way to compound over long periods of time, as long as you have idiosyncratic return drivers and businesses that aren't overly correlated. You can lean into dislocations. And if you own great businesses through a cycle, they tend to come out stronger. So that cash drag is the real other burden that sort of a lot of other people just haven't hit on, that was really foundational for me in setting up the business today.
And I know you feel like you met a lot of managers who lacked the necessary differentiation, which is an interesting juxtaposition because these people are charging incredible fees and making themselves very wealthy, but somehow lack what you thought was special. So I'm just curious about, and I know you thought deeply about this, the traits of undifferentiated managers, and then kind of like how that has influenced how you set up your firm.
Yeah, and I hate to oversimplify things, but I do think simplicity is really underappreciated. And so simplicity, focus, and alignment are sort of the hallmarks that undercut that foundation that I was alluding to earlier. And so, Peter Kaufman basically has 4 tiers of learning, and it breaks down, how we learn as people. And I think a lot of the best investors in the world really get to level 3 or 4. The first level is you continue making the same mistakes. You don't ever learn and you keep running into the same dead end, right? The second level is you learn from your own mistakes, you don't repeat them, and you figure out a path very slowly. The third is you learn from the mistakes of others and you don't repeat them. And then the fourth is you keep making right turns and you learn from the mistakes of others and you emulate them. And so a lot of that sort of comes down to like the mistake avoidance. When you think through the types of errors you make as an investor, is it a type 1 error or a type 2 error, right? Are you focused on really high quality businesses? Or are you taking a lot of risk in businesses that aren't likely to be high quality, but they might turn out to be high quality? Or, type 2, like, are you just missing, the next NVIDIA? And so for people like you and I, Ben, I think a lot of it came down to, that type 1 error. We just removed a lot of the really low quality businesses. But staying as close as you can to the companies and really just focusing on what makes them tick and decomposing drivers of return is, I think, the most important thing. And I think what you were getting to was why do some of these great investors fail and what makes you different? And I'd say that focus component, once you get beyond the simplicity of the strategy, is the challenge, right? Because we all, I think, want to be good partners to our investors as well as to our analysts. And over time, people's desires or goals shift. And so for the most part, everyone starts adding strategies or empowering their analysts to have a larger voice in the portfolio. And if you believe, like I do, that concentration is required to outperform, that really doesn't leave a lot of room to having multiple sort of portfolio managers or people express a view, because everything is related in a portfolio. And so you've got to stay true, I think, to one product or one strategy, have that be your sole focus, and really just have a really well-aligned team and limited partner base. And over time, if those people have done that, and there've been a few hallmarks of it, Pulak Prasad at Nalanda, or, Cedar Rock before they shut down, or Nomad before they shut down, ultimately the right thing that comes for most of these investors is just move on with their life, because it gets really challenging once either your pool of capital gets too big, you have too many employees, or you have too many partners who want different things. And so that being really focused and disciplined, as well as the alignment, those three sort of simple terms of simplicity, focus, and alignment, I think a lot of people don't appreciate. But going slow with aligned partners and staying small and being focused on the investing piece is the most important thing. But I think most people spend a quarter of their time marketing the fund, managing the team, and over time thinking through different parts of their life and really how to manage a lot of the complexity that I think is unnecessary. I haven't seen any study that shows a larger team or more products creates higher returns. If anything, I've seen the exact opposite. But this real focus on small teams and simplicity gets lost a lot. And that consistency of execution, I think, doesn't really bear itself out for oftentimes 5 or 10 years. And so for people like you and I, that's challenging, especially when you're sort of at our phase in life, because you need a long runway, especially if you don't get lucky at launch. And so that makes it more and more challenging, because the training grounds today, Ben, as they're largely mutual funds or hedge funds, and the time horizon is getting compressed pretty dramatically. And then if you are in one of those organizations, your purview gets really limited, where you're covering a subsegment of a sector. And the reality is, I think the biggest benefit for people like you and I is range and understanding that there's all sorts of different business models that work in different environments and different geographies. And just having that range to identify and track them, it's almost absent. There's no real training ground for it today outside of some of the legacy, investing masters that you and I have known about. But there's really almost no pathway in there for aspiring analysts.
Thought a lot about the paradox, which is what's best for the firm, which is probably to have 1 million analysts covering every subsector, right? So you're an expert on everything, is not what's best for that person, because how do you become a PM if you've only covered, like some subsector of an industry, right? You don't, that the power of the generalist model loses
a lot of its luster and then what you create is a bunch of people who are best suited to run at a pod shop, but never do what you're trying to do. And that's, and I think it speaks to the size and the desire to gather assets and, show the consultants that you have a firm, right? As opposed to just like two guys in a room picking stocks. So with all of that as a backdrop, I mean, you talked extensively about alignment already. I'm just curious about, you talked about removing friction. Maybe I'd love some tangible examples of that, and fees. How have you thought about using the fee structure to create alignment? Maybe you can discuss all that.
Yeah, happy to. And the alignment piece is foundational, all through this strategy, but it really transcends, the partnership and how it operates. So when you think through that sort of 360 Oculus view I was mentioning earlier, you've got partners, you've got employees, you've got service providers, you've got the regulator, you've got the communities. A lot of that's really sort of not relevant when you're starting up, but the amount of sort of infrastructure required to launch a fund today is mind-blowing. And is mind-blowing from my perspective as well, having sat on the other side, because of these onerous regulatory requirements. And if you were looking at my portfolio or probably yours with 10 or 13 stocks in it, it shouldn't cost $1 million to manage this or fulfill compliance or regulatory requirements, especially if you've got the background like you and I do with CFA and CPA and MBA and all those other things. It really is about as simple as you could imagine, as long as you're not trading very much or shorting or using leverage. But the amount of transparency and communication is really one of the things that I found the most lacking at the sort of partnership level inside the endowment. Because if you're not close to it on a daily basis and you don't understand what businesses you hold in what proportions, you can get some surprising performance numbers on a monthly basis. And if the liquidity isn't attractive for limited partners, like started happening in the business, over the last 20 years, liquidity really went in favor of the GPs. And you see that even more pronounced on like the private equity side, as those allocations got larger and larger in the portfolio. And so that put more and more pressure on people managing either the public portion of the endowment or the endowment in general. And so what you have to do then is create the liquidity somewhere else or have other tools to manage the portfolio so that you can either take advantage of dislocations or fulfill your obligation to the organization, which in most cases we'll just say is 5%. And so if you're me, you wanted more transparency, more liquidity, and lower fees. And what happened is they went the other direction. At the same point, expected returns were degrading. And so for me, thinking through like, hey, what works and what's fair, and what actually creates that sort of alignment with partners. And so, monthly liquidity, full transparency, everyone knows what they own, why they own it, and in what proportion they own the business, and they can take their money out anytime they want it. And they should have 90% or more of the gross return, right? And if a market's going to do 6 to 9, and hopefully I can do 15 over long periods of time, that should be a fantastic return for limited partners. But if you look at what most hedge fund structures were doing between the management fees and the incentive fees, they were taking over 30% of the gross returns, right? Expected in lower return environments, which I think we're getting back to, that really is unpalatable for almost everyone. And, it was very easy for a typical US investor to get excited about owning an index since the GFC, right? 15% returns, that's fantastic. But if you're in the new sort of return environment, I think we're in for public equities of 6 to 9%, you're going to be really frustrated if you're still anchoring to that 15% return. And as I sort of alluded to earlier, people chase returns. And so, a lot of them went into equities at the top, or they're chasing semiconductor stocks right now. And that's the challenge. And I think for a whole host of reasons, it's probably one of the best backdrops for active management. But because the market has done such a poor job of servicing the clients and creating alignment, there's a massive opportunity. The challenge, though, as I alluded to, and I think you agreed with, Ben, is it's hard to validate your skill without having a long enough period of time and showing that you can be a great partner. So a lot of it comes down to those relationships that people like you and I have built with that cohort at Berkshire Hathaway over the last 20 years. And I think it ultimately does bear itself over time, but that discipline in terms of execution of that consistent strategy, communication, and then performance, it's very rare. And then getting people who don't just take in as much money as they can to sort of offset that lower fee, is the challenge. There are a few people that do it, but I think that ultimately internal scorecard of what's important to you in life while maintaining the external performance basis is the rarity. And so, trying to stay true to that and do right by your partners is ultimately the North Star.
Thanks for that response. I think this would be a really good time to segue into the strategy you're running. Can you give us an overview of the strategy in terms of philosophy, and then maybe cover as well the size of companies you're invested in and geographies as well?
Yeah, absolutely. So, ideally it's a 10 stock portfolio. Today there's 13 names in the book, and the largest is about 12%, the smallest is about 4%. I think risk management is the most misunderstood thing, but before you get there, you have to understand a concentrated, fully invested portfolio of 10 businesses might have a lot more than 10 businesses underlying it. And so, Constellation Software, which I own in the portfolio, has 1,000 vertical market software businesses that underlie it, right? I don't own Berkshire Hathaway, but I think it's a good example for your listeners. The reality is there's hundreds of businesses that underlie Berkshire Hathaway, even though it manifests itself as one business or one ticker symbol in someone's portfolio. And so for me, dissecting the businesses and making sure myself and the partners have a good expectation of what they own and why they own it. When you start thinking through Google and Amazon and Microsoft, there's a lot of businesses underneath those one corporate entity structures that you and I can invest behind. And so for me, thinking through hey, what is the right way to get to a somewhat predictable 15% return with alignment and good transparency for partners, where hopefully I can lean into dislocations and get closer to a 20% return, is sort of the holy grail. And I think what's really misunderstood, Ben, is that the big have been getting bigger and they have been winning. They've used their economies of scale and a whole host of other competitive advantages, which I use the Hamilton-Helmer 7 Powers playbook to sort of serve as the foundation for the lexicon. And when I look at those businesses today, there are some really undeniable truths in terms of how much they've invested to maintain or grow their competitive advantages. And so while I don't specifically pursue the largest and best businesses in the world, a lot of those best businesses have gotten big for a reason. And so, I own Microsoft, I own Amazon, I own Alphabet, and I own Meta. And there are some really unique elements to those businesses, even though they're $1 trillion plus in market capitalization. But I also own a $5 billion market cap business. And so, for me, that sort of strategy evolution over time, once you get beyond the foundational elements of fully invested, long only, fundamental, cash flowing businesses with great alignment with the underlying shareholder base and management in terms of ownership of the common stock, you can really get excited about a lot of different business models that might have idiosyncratic returns and offer you those really predictable 15 to 20% 5-year expected returns that I'm pursuing.
And you mentioned the level of concentration. I'm curious, in your mind, what the difference is between a 12% position and a 4% position. Is the 4% a more risk-weighted position, or maybe to protecting your downside? Is a 12% position, what you have to think is the highest upside? Maybe talk a little bit about how, there's a decent variation there, how that comes about and what the philosophy is behind it.
Yeah, of course. In a perfect world, all 10 positions would be idiosyncratic and have the same expected return, and they'd all be a 10% weight. The reality is the world isn't perfect, and I think portfolio management, if you believe it's an art, does require some diversification across company maturity as well as risk. And so the smallest business in the portfolio today, or the two smallest of about 4%, is Canadian Pacific Railroad and Procore. And so I own both of those businesses for very different reasons, but they're almost completely uncorrelated. And I own them because Procore has one of the highest expected returns. It also has the lowest cash flow yield in the portfolio, and therefore you could argue the highest risk from a valuation perspective. I also think it has one of the highest or longest runways for high rates of compounding, as it's one of the lowest penetrated software markets globally. And I think they're the clear market leader. On the other side, the most mature business in the portfolio, you could argue, is Canadian Pacific Railroad. And these railroads that can issue 100-year bonds, they're really the only ones that can do it, are probably the most mature, well-understood businesses in the world. And there will never be another Class 1 railroad built in North America. And I think once you think through the different fundamentals that drive them, they're incredibly different, right? So Canadian Pacific Railroad is moving commodities around North America and the world to help really build infrastructure and give people their goods versus a software business that's helping increase the efficiency of construction globally and build infrastructure. They look almost nothing alike. And so one is because it's more risky and very expensive. The other is because it's the most defensible. And over longer periods of time, either one, it could be used as a source of capital. But in a perfect world, you'd get something like Procore that could compound at 26% for the next decade or a 10x in 10 years. And I use that as a source of capital for another investment that looks more like Procore today. And the serendipity of all this is, Ben, no one knew what was going to happen on Saturday in terms of, President Trump's, assassination attempt. No one knew what was going to happen with railroads a month ago. And so when I launched the fund in November, the reality was the world was a really uncertain place in terms of interest rates and inflation. And I was really surprised by how quickly markets started pricing in interest rate cuts. And you and I could argue they're still probably too high, but we're also the last people who are going to prognosticate on interest rates. And so for me, having a nice, healthy balance of cash flow and drivers of return. So I use the old Kroner model to disaggregate expected returns. And so I want a return of capital in terms of dividends and share repurchases. I want existing cash flow that's being reinvested in the business. And then I hopefully want some multiple expansion over time, the old Shelby Davis double play. And then hopefully they're incubating new businesses internally. And if you can start thinking through a nice healthy component of each of those across the portfolio and across different business models and sort of sectors, you get a much more defensible portfolio. But each business really does have a lot of elements of anti-fragility in it. But on the other side of the portfolio, after hitting on the smaller businesses, the larger companies today, the ones north of 10%, it's Apollo and it's Brookfield and it's Amazon. And those companies, I think, are actually really attractively priced in the market today and have a lot of misunderstanding around them in terms of cash flow growth over the next 5 years. And so if you look at Apollo today at trading on 12 or 13 times cash flow, but growing, 15% plus for the next 5 years, and what they've built is one of the most predictable businesses in the world, leveraging really the legacy Berkshire Hathaway model of long dated annuities to invest in, private IG credit that gives you a 2% spread. That's a 20% ROE trading, below book, where they are now the largest annuity and credit originator in the world. And it's also trading at, less than half the market multiple or half the market multiple, depending on how you measure the carry in the business. But I'd say the same with Brookfield today. If you look through all the cash flows of the business and the assets on the balance sheet, it's trading at about half a book value relative to Berkshire at 1.5 times. And it's functionally a capital-like compounder using funds to call cash flows from investors. And then you get a very predictable management and incentive fees. And the incentive fees function like baskets of call options. It's got, basically a 5 billion yield that's trading on 13 times with a lot of embedded upside from the carry in the funds. And so, I think a lot of it's just misperception, but the reality is, as long as there's some misunderstanding, and I do think there is in terms of the complexity of these businesses, their interest rate sensitivity, and then, maybe some risk around, credit quality or real estate, depending on the company we're referring to, that ultimately is what creates the opportunity in some of the position sizing.
And you mentioned that ideally you would have 10 stocks and now you have 13. Is that mainly a reflection of the valuation that you see these companies trading at? You're just a little bit nervous about having just 10 stocks but in a March 2020 or March 2009 scenario, you would think about you would make those tough calls and be like, I want to go to battle with these 10 for the next 5 or 10 years.
Yeah, it's a fair question. And, I've traded 8 days since I launched in November. So I'm not waking up thinking about trading the portfolio at all. The only two companies I've exited are Visa, because Capital One and Discover, I think, are going to reprice the economics that Visa and MasterCard have enjoyed over the last 20 years. And then Canadian National, as I just had a business that had twice the expected return. And so for me, the 13 businesses and some of the more mature ones, like a Constellation Software or a Microsoft, or some that just have lower expected returns, they serve as a source of capital during a dislocation. And I do think we're headed toward a period of higher volatility. I just have no idea when that's going to manifest itself. And so when you look through all the different business models and businesses that I track, and there's about 200, a lot of them have very different sorts of level of understanding in the market. And software is sort of being neglected to the benefit of semiconductors lately. But the reality is you never know when something's going to get really attractive. And so for me, understanding the business deeply and waiting for strong business fundamentals that aren't showing up in the financial statements yet is really what I'm going to lean into. And some of that is sensitivity to being a newer fund, but also a lot of it is around just trying to be disciplined around valuations, because I think over the last 15 years, as you probably noted, a lot of people got lulled into some valuation sensitivity or thinking through, hey, this is going to be great over 10 years. But if it's painful over the next 2 or 3, and you've got a lot of similar types of businesses, those returns and sort of those outcomes can be really challenging to live through. And so for me, trying to manage a really diversified portfolio across different sort of, expected markets or, highly probabilistic realities has been the most important thing. And so owning 13 as opposed to 10 just gives you a little more flexibility. But, over time, it could only get down to, let's call it 6 or 7 if there were 6 or 7 businesses that all had similar upside that were outstanding, and I couldn't find anything else. On the other side, do I ever think I'll own 15 or 20? I don't, but in a really uncertain environment where nothing really looked that attractive, I could see diversifying more significantly.
You mentioned in that response the watch list of companies that you have. I think it's 100 plus. With a small team, I'm curious about how you manage that and and the amount of time you spend on new idea generation versus making the maintenance required on the 13 stocks that you own.
Yeah, great question. And, Ben, so a lot of this kind of comes back to what people like you and I have done with our lives until this point. It won't surprise you that about half of my portfolio today were things that we put in Emery's endowment 6.5 years ago. And so, these best businesses in the world, they don't really change all that often. There's some new competitors that come up, or as markets and, sort of sectors or segments of the economy evolve, profit pools change sometimes. But the reality is it tends to be very noticeable. And so for me, when I think through these 200 businesses that I track and 100 that I track more closely, it's software, it's payment processors, serial acquirers, railroads, irreplaceable assets, these permanent capital, alternative asset managers, the rating agencies, testing businesses, aerospace and defense. And you can really see what's happening, I think, at an underlying level. If you go to trade shows and you have a lot of conversations with people in the industry around which businesses are just exceptionally well managed, something like a Danaher, which I don't own, or someone who just really has great alignment in terms of building a strong culture that's going to be able to execute over long periods of time. And then the challenge becomes, as waiting. For me, seeing what happened as an anecdote, with Blackstone and getting included into the S&P, that's a fantastic business. And I actually think, being capital light might work well for them. But that was trading on, 25 times cash flows versus a lot of these permanent capital alternatives businesses that at that point were trading on 10. Of the best performers in the fund since launch, it's I think some of the businesses that were just hiding in plain sight, like a KKR or an AppLovin. And both of them were trading on about 10 times cash flow when I bought them. Although they were really predictable, high quality cash flowing businesses with some of the most aligned management teams out there. And so for me, a lot of it just sort of comes down to being patient. And as I was referring to, a lot of the decisions that I do make around the portfolio management or the investing side is trying to think through what are the most sort of anti-fragile businesses at this point in time that offer the best upside. And so when you think through the permanent capital alternative asset managers today, in a really stressed economic scenario, they have hundreds of billions of dollars of capital that they can draw down and invest at really attractive rates of return and pull forward, incentive fees and carry, thus increasing the expected return and reducing some of the downside scenarios that you might expect. They actually benefit from volatility, right? And I'd say the same is true for like a Constellation Software. If you think through what Mark Leonard and that team are able to do in more stressed environments, they deploy those cash flows at much higher rates of return. And so very different businesses, but still have some of the same anti-fragile characteristics that I'm looking for, where, if we weren't headed to an interest rate cutting market, these businesses might have benefited a lot more than they have coming into this maybe more soft landing type of environment. And so for me, it's all about sort of understanding, how do these things all fit together? How do I not just fall in love with one type of business? And I think that was the real challenge in seeing what challenged or was an ultimate detriment for a lot of our partners over the last decade, where they were really heavily invested in what had worked, whether that was software or e-commerce or growth tech. And a lot of people making private investments or going into different parts of the market where they didn't have as much diversification or flexibility. And then when the market re-rated, they ran out of options. That's sort of the challenge to wanting to track a lot of different types of businesses. And that's why they need to be more predictable. And I'd say a little bit more mature. If you go back to Buffett talking about airlines, 50 years ago, or railroads, 120 years ago, once businesses mature and are more predictable from an economics perspective, that tends to be when I get more excited. I always want them to have cash flow. And I think that ultimately is what backstops the return on most things. But you need that, or you need something to lean back on when the market gets really soft, so that you can come through it stronger and with a good understanding of what a downside return looks like.
You talk about being a new fund, but you also mentioned that you've owned a lot of these stocks, or at least going back to the Emory days. I think anyone listening to this and thinking about potentially partnering with you would wonder, has a portfolio changed materially since the days when you were running it at Emory? I know you're limited in what you can say there, but I think people would like to know that there's a little more continuity than maybe just just starting in the last kind of like fall of last year.
Yeah, of course. And UCLA and Emory are both outstanding organizations. World-class governance. The CIOs and the investment teams, I think, are some of the best in the world. And you've seen a lot of these allocators and family offices move towards more principal investing roles. And I think that's absolutely the right longer term movement. I'd say, it's sort of two steps forward, one step back in a lot of cases in terms of building trust across the organization and having that validated through strong performance on an absolute and a relative basis. And, for me, a lot of it was understanding how others viewed the role of the endowment. And I think that ultimately is viewed differently by almost every stakeholder there is. And so I think some of the unimpeachable elements come back to, if you think through what Jeff Bezos was trying to accomplish, saying, what aren't people going to want to change in the next 10 years, right? Lower prices, quicker, better selection. Those sorts of things are always very relevant. And for us, if you look through the sort of business exposures you were getting from managers, there is ultimately a lot of correlation or overlap at the top. And, I don't think that's a bad thing. I think if anything, we should have leaned into that more. So most endowments really never had much exposure to Apple or to Tesla over the last decade. And a lot of that was because their partners would argue, you didn't pay us to own Apple or Tesla. And, if you're me, that might be fine for one business or two who might have like an eccentric, sort of CEO at the top. But like, why be underweight Visa, right? Why be underweight MasterCard or Microsoft or Amazon? And a lot of these things sort of just lent themselves to, well, how do we make money and how should we be making money, right? And so the long short strategies in particular, almost no one was making money shorting. And the fees certainly offset all of the excess return that you would ever expect to generate. And then over longer periods of time, because they weren't 100% net long in a drawdown, you didn't want to give them more capital in a drawdown scenario, right? And so when you thought through the flexibility and the tools that you wanted to become a better steward of capital, you wanted to have more flexibility and you wanted to own more of those great businesses, especially at the bottom. And so a lot of the sort of alternative asset manager businesses, or natural oligopolies that have rational pricing power like Visa and MasterCard, like I think those should be in almost every endowment in the world. And they do show up, whether it's their managers or them owning them, but it does require a lot of trust across the entire organization. And so I sort of alluded to it. The strategy evolved, and I think owning 10 stocks is not the sort of right backdrop for most endowments, right? Should they own a few hundred? You could argue that's maybe over diversified, but when you look through the sort of exposures they get from their managers, they're far more diversified than that. And so I'd say when I thought through the very simple win-win solution, it was creating more concentration in the higher quality companies where we could charge lower fees and add more during a dislocation. And some of that is understanding how people react during times of stress, right? No one likes adding to highly levered, low quality businesses at the bottom. But what even very inexperienced non-investors will understand is the expected returns go up after periods of declines in the market. And so understanding that and getting people comfortable with the businesses they're investing in was ultimately a much easier sort of strategy to pursue. And I think every organization is probably different and they have to go through it. I know there's large endowments that day trade ETFs and things like that. That was not our MO at all. We wanted to own outstanding businesses and be great partners to the GPs that worked with us. And the reality is, we didn't do anything to diminish that relationship or to take advantage of them. But for us, it was all about trying to help the organization better invest when it had the ability to do so, with the ultimately limiting constraints that we all have of liquidity, standard deviation of returns, and correlation. And so for us, there's only so much you can control if you're investing through illiquid structures or through hedge fund structures that might have 2 years till you get your money back. In a lot of cases, that liquidity becomes really, really valuable during periods of stress. And so you want to try to optimize for that. And I think that was really ultimately what the right role and implementation is for most endowments, even though that's not what I'm trying to do today.
And so you talk about that stereotypical response to owning the big stocks, like, well, as an allocator, well, what am I can buy these through the S&P, especially given how concentrated the S&P has become in the Mag 7 and the hyperscalers. I'm curious how you think about, one, your differentiation as a manager and owning those things that can be owned, in a concentrated perspective from the index level, but also how you talk to people about it when they're talking about your strategy, when they look at it and say, oh, these are all household names, basically, maybe not Procore, but the rest are household names. How can you be differentiated and better if you're owning the things that are like everyone understands and knows about?
Yeah, I mean, that's a fair question, Ben. Here's what I'd say to you. I think you and I might be geeks and love investing more than almost anyone else. The reality is, when you look at my portfolio today of 13 businesses, only 4 are in the S&P, 5 now with KKR being included a month ago. But the reality is, like, it had doubled for me before it got included in the index. And so when you think through not owning Microsoft, Alphabet, Amazon, and Meta, those were ultimately like the biggest mistake that most people would have committed over the last 15 years had they chosen not to own them. And it ultimately comes down to a question of, what do you think the expected returns are for the index and what will drive those? And so I know we'll get into the hyperscalers, but I do think they've ultimately almost sealed their fate to some extent for the next 5 or 10 years, or maybe even 20, in terms of the amount of data and the amount of infrastructure investment they've made in storage and compute globally, to where you almost can't compete with them. I wouldn't want to be underweight them, but in aggregate, those 4 businesses are less than a third of my portfolio today. And ultimately, while some of them might not have higher returns than the portfolio in aggregate, I think they are a very safe way to generate fantastic returns over the next 10 years. Because of how defensible their business strategies are. And so when we talk through that, a lot of these businesses like Alphabet or Google, as people would know it, most people don't understand what it really is. They think it's a search engine. And the reality is, that advertising business, they scorched the earth for not just like 10 yards around it, like 200 miles around it. And they gave away everything else for free. And so when you think about the Android operating system today being the most dominant in the world, which, they're not monetizing. When you think through YouTube being the largest streaming platform in the world today, that's really at nascent stages of monetization, right? And then at Google Cloud, it's the smallest of the three hyperscalers in the world today. And so there's a lot of latent, underappreciated assets in the business that I think people just don't understand. And the biggest mistake I think a lot of people make is, they sell these things too early. And that would have been the case for me and like Apple in 2011 when we were in the student fund together. The reality is like I just missed the last best 14 years of compounding in that business, despite it being already a large company. And so for me, a lot of that learning is just understanding where does scale really help. And if you go back through the science or empirical evidence of the world, power laws are real. Like these companies got big for a reason, and they are in general outstanding companies. Some are certainly run better than others. I'd say Microsoft's probably one of the best run businesses in my portfolio. And then on the counterpoint, I'd say Alphabet's probably one of the worst run businesses in the portfolio. And I think you see that in terms of the cash flow yields that they trade on. But ultimately, a lot of that then creates upside for something like an Alphabet. Now, where do I think it goes in terms of a $3 trillion market cap company? I think we were both lamenting a $300 billion market cap Alphabet, 13 years ago and saying, gosh, how big can this really get? How much money can they actually make? And I remember having the conversation. And so a lot of it just comes down to being nuanced and trying to stay objective, which, going back to the portfolio management piece, you never want, I'd say, for me, more than a 20% position size in anything. But, the reality is being underweight one of the best businesses in the world or some of the best businesses in the world, particularly when they're maybe under monetizing some of their different business units. It's not necessarily something I feel like I need to communicate a lot, although it does make it harder to differentiate. And I think that's why over longer periods of time, the returns should bear themselves out. Ultimately, the biggest cross to bear over the last 8 months since I launched was not owning NVIDIA. And, chasing those returns or chasing a company, particularly semiconductor company, has ultimately been the wrong decision at this point. Although I'm really convinced it's the right one at this point, just given what the business actually does and how in supply and demand have manifest themselves for semiconductor businesses at every point in the past. And so I view Microsoft, Alphabet, Amazon, and Meta as very different types of businesses. These are very defensible, largely software businesses. You might call them advertising businesses, but when you think about how dominant they are on a global basis, particularly given what's happened with the Chinese companies that were the largest threats, today they're almost completely unencumbered in terms of their ability to really add productivity and value to the global economy. And they keep reinvesting all these cash flows at what I think will be exceptional rates of return.
And I guess the question I would have for you as a follow-on to that is, so there is an argument to be made that maybe some of the returns have been pulled forward and the forward returns are not going to be as good. I mean, how do you think about you could argue that they're going to continue to be incredible businesses absent maybe some unexpected regulation or changes to the regime there. I guess I'm trying to figure out how you think about the position in the portfolio given the size they are now, and to some degree at some point the law of large numbers starts to matter. So how do you mix all of that as you're thinking about where they sit in position size in the portfolio?
Yeah, no, it's a fair question. And so today those four businesses in aggregate are about 32%. And the challenge really comes down to, where do you think we're at in terms of cloud computing and how important is that infrastructure layer? So let's just say that they have most of the data, they have most of the storage, and they have most of the compute on a global basis. And we're 10 to 20% penetrated in terms of cloud today. And that value proposition is profound relative to on-premise computing for almost every individual and business in the world today. Yeah. And when you think through AI and the enhanced productivity that you will get from that, and them having a near monopoly on the language models that power AI. I think some say we're still in batting practice. I think we're probably first or second inning, but the reality is almost no one can invest $30 to $50 billion a year. And when you think through what is in a hyperscale data center today, that's 300 megawatts, that's $3 billion, where you can't even get power. If you called PG&E today and tried to just get 50 megawatts, let alone 300, in 2 or 3 years, they would laugh at you. They don't have any excess capacity, certainly at that scale. And so what you see now is Microsoft, Amazon, Alphabet, Meta, everyone, they're building data centers in Illinois and Indiana, right? Like Northern Virginia, Nevada, and California, which were like the primary markets where you would really want to set up. That's really not where they're going because they can't even get the power. It's not just the, H100, Grace Hopper chips from NVIDIA, let alone the Blackwells that are about to come out. If you just even go to NVIDIA's, sort of disclosures, the best returns for any of their customers should come from these hyperscalers because they're renting out capacity on the chips. And so what this then becomes is almost like a sort of timeshare or fractional ownership business where they leverage their network effects. And the more data they have on their platforms and storage and compute, the more powerful they get. And because of data gravity, if your data is already there, for you to shift your model training or inference to another cloud, it gets incrementally more expensive. So you have to be significantly better than all of these incumbents. And you somehow have to catch up on data and infrastructure at the same point. And they have the lowest cost of capital, Ben. So at this point, whether you like it or not, like they are some of the best credit quality businesses in the world that are gushing cash and already have the latent know-how to build liquid cool hyperscale data centers of 300 megawatt size. And that's just incredibly rare. Like you're using capital then as a barrier to entry. And I think that's the most misunderstood thing. I think people think we're already there. And I think we're just early innings. And when you bring up AI and where they're at, we're scratching the surface. I don't know what that looks like. I just think from the infrastructure layer, that battle's already been won. And so if you go back to Bezos, a lot of their earnings today were basically baked 3 or 5 years ago when they made their capital allocation decisions. We're seeing that now in terms of where these companies are investing. And so, we'll see what happens with NVIDIA and how many chips they can sell at what prices in the next couple of years. But ultimately, demand peaked at the end of 2023 and sort of has been coming down as people have been able to get the resources from these existing hyperscalers. And then, you'll see some things around the fringe with, Tesla or Twitter or X, building their own infrastructure. But, for the most part, no one's competing with them today.
And is that capital intensity, which hasn't always been present in these businesses? I think people think of, especially like Alphabet and Microsoft, as being mostly software. Does that capital intensity change the business model forward, returns on capital? Or do you think that the benefits to scale are just so massive and the runway is so massive that they can continue to generate way above average returns?
Yeah. So, I'm clearly in the camp that they will generate fantastic returns. And the most mature is AWS, that's on $100 billion plus run rate at this point with, mid 40s margins or better. Incremental margins are significantly higher than that. And, if Google Cloud gets to that point, given the current valuation, that's a home run. And so once you start thinking through the ability to scale and leverage the data that they have, which almost no one appreciates. And, this is, I think, one of the most misunderstood things about Amazon, right? That they have the data and now they're building, this beautiful advertising business. They already sort of leveraged Prime by putting the moat around the best Amazon customers, a decade plus ago. And so the reality is, if you think through the robotics infrastructure that they have and how they can leverage that to take advantage of AI and more productivity and replacing labor with capital in their warehouses to increase, delivery times and more throughput at lower cost, they ultimately become something that you almost can't compete with. And I think, where they decide to extract the economic rents is the unknowable element, right? No one could have predicted that Google would give away the types and number of services that they have to protect that core search algorithm. And at the end of the day, we'll see how much Microsoft decides to monetize through Copilot versus just charging more through, 365 or any of their other products, because they've had this awesome land and expand strategy where they use their distribution as advantage, right? Whether it's Microsoft Teams or their security offerings, where they're just bolt on another tool to the overall product to increase the value of the bundle. And I think that's the nuance that makes it really hard to regulate. The regulation element was something we were talking about a lot more in 2018, but because they've now got these, value propositions that are unimpeachable, right? These products are almost universally necessary at this point. If you want to be able to, even enhance or maintain the level of productivity that you have relative to, these endpoint solutions that are largely going by the wayside as people reevaluate their IT budgets. The complexity in all of our lives and the software infrastructure or the data, everyone's streamlining and coalescing around these platforms that do have the data, the infrastructure, and the software. And by being able to blend them somewhat seamlessly, you almost don't know where they're extracting the economic rents in a lot of cases. You just know that you're getting something that you didn't have before, and you're able to accomplish a lot more, even if the prices go up a little bit.
And I never want to leave a discussion with the manager without talking about mistakes. Before we hopped on record, we were talking about some, public mistakes that I've made as an investor and how I've learned from that. Is there an investment mistake that was so profound that has forever changed the way you make decisions?
Yeah, and I think you have probably had a front row seat for it. We were ultimately talking about Apple and the student fund, and it's one of those that like I haven't lived through professionally yet, and so it's just understanding that some of these businesses can scale a lot bigger than you'd think. But the biggest lesson I ever had was around low quality businesses, commodities, turnarounds, and promotional management teams. And so the biggest mistake I ever made was a mining company that was going to process the tailings and pull out nickel and copper and all these other things that would have made it, basically, let's call it a 10 to 50 bagger. And what ultimately happened is the same thing you've heard so many times in your life. Management was lying. Everything was basically a false document. And you just learn that there is no replication or substitute for quality cash flows in high integrity people. And so putting all of those other commodities, low quality businesses, promotional management teams where it's too good to be true, in the too hard bucket was that most important learning for me. And so that mineral and mining company, it cost me what wound up being like a fraction of a mistake today. But at that point, it was really important. And I swore I'd never do it again. And when I see people make mistakes today, or when I look through the portfolio around where people make mistakes, it's investing in things they don't understand with promotional management teams, whether it's, some of the venture fluff that we saw 2 and 3 years ago, or, the cannabis or commodities type of stuff we've seen come up in Canada several times over the last 20, 30 years. And so for me, I just swear all of that off now. And that was really the best lesson.
And you started your fund last year. If we're having this conversation again in 7 years, what do you think success would look like to you for this new venture?
Yeah, ideally the returns stay outstanding and the clients are very happy. The reality is, I think the biggest cross to bear for anyone who manages money for other people is maintaining the returns as you grow or over longer periods of time. Peter Lynch is one of my heroes, and the sad story about the Magellan Fund is almost no one outperformed the index, even though he had one of the best track records out there. And when you're on the allocator side, or when you're an investor in a lot of funds, you realize it's not about time-weighted returns so much as it is, dollar-weighted returns. And if people take their money out at the wrong point in time, there's nothing you can do. And so trying to be a thoughtful communicator of expected returns, really is the most important thing. And sometimes that'll probably mean giving back money or telling people they should lighten up after a period of strong returns. That should be a part of the conversation most people have with their investors. And then, the counterpoint to that is hopefully during periods of stress, you've earned some credibility to say now's a really good time to invest. If you have a few dollars laying around, you should really invest. And if you can sort of create that alignment where both of your chairs are on the same side of the table, I think you're going to yield outstanding results that are almost irreplicable, because I alluded to earlier, most people invest at the wrong period of time, right? They chase returns They leave at the bottom. And JP Morgan puts out this study, and every one of their guide to the markets, they show you the trailing returns of the last 25 years. And most people barely keep up with inflation, right? And there's a reason for that. And that's what I was just alluding to. They don't know when or how to really invest over long periods of time. So most people should just invest with someone they trust in high quality businesses and leave it there forever. And I think we'll hopefully get there in some of these retirement products because a lot of people not having the option of a pension, I think, are going to be left to their own devices and make some really challenging mistakes down the road. But yeah, for me, it's 15 to 20% and making sure the partners are happy and they don't make some of those mistakes that will inevitably happen if there's not trust on both sides.
And how do you distinguish a partner who is going to do the wrong thing at the wrong time versus someone who's got that more patient capital? I think everyone talks about being patient until there's a liquidity need in the portfolio or their private equity funds are not distributing anything and they need cash from public equity managers. I'm just trying to get a sense as you've thought about the right LPs and the right partners. How do you snuff out the people who are like truly long term versus it's on their website that they're long term?
Yeah, well, Ben, everyone says they're long term. And having heard thousands of pitches, they all sound the same, right? So for me, I'm not trying to market this partnership at all, right? And the reality is, like, these products are bought, not sold. And I think if you are very disciplined around taking in one or two or maybe three new partners a year, and those people show a real interest in getting to know you, as opposed to you trying to push product on them or however you want to frame it, it will manifest itself over time. There are unquestionably some endowments, foundations, and families that have proven themselves to be long-term, right? And I think there's a subset of investment managers who pursue strategies like ours where you know who they are and you pursue them to some extent, even if it's as passively as possible, so that if there is a good fit, then sort of when to engage and they know who you are. But the reality is, like, just being patient and waiting for that sort of intersection of mutual interest to occur, I think is the best thing. I know marketing is like the lowest return on time for me, and I try to do as little of it as possible.
Mm-hmm. You and a lot of the people we know. I think that's almost par for the course for people who love the investing game the most. So Jim, this has been awesome. It's been great to hear about your journey, and it's really impressive the degree to which you've thought about the structure, but also portfolio construction, and then the depth that you're able to go into for these, for all the companies you own. We're going to close with a question we ask all of our manager guests, which is, what is the most underappreciated aspect of the investment opportunity in front of Maestria today?
Yeah. So markets are getting less efficient, and I think the beta trade is over, right? I think now is really the unique time for partnerships like the one I'm trying to build to take advantage of people going passive, people focusing on privates, people pouring massive amounts of capital into platforms that are inevitably very short-term investors that use a lot of leverage. But if you think about the returns that the market or indexes, at least in the US, have generated since the global financial crisis, the reality is they're not going to look anything like that over the next 6 to 9 years. And the people who are disciplined and can take advantage of the very few, really awesome opportunities to compound for a decade in fantastic businesses, I think are going to be structurally advantaged. And you've got to be focused, and you can't have $50 billion, right? It's got to be something that can move very quickly and understands, where to lean in, spend time and resources. But those markets getting less efficient and understanding that there are some real scale limitations to what people can do. I think those are the biggest misunderstandings.
Yeah, I would add, just add anything down market cap is an addition to that, like, just whatever. It's the thing that gets whipped around the most with all of that stuff going on. So I'm in agreement with you about the role of active management, and I would just layer on the small versus large opportunity remains, I think, a great opportunity for people willing to go down there. Jim, I'll leave it to anywhere that I don't know. You still don't spend any time marketing, but where do people find out more about you if they're interested in learning about your firm?
Yeah, I guess you can send me an email at james@maestriapartners.com. But no, this has been wonderful, Ben. Thank you for your time and all the thoughtful questions.
Yep. We'll do it again sometimes. Thanks a lot for being on Compounders, Jim.
Thank you. Goodbye.
Jim Edwards mentioned a number of securities on this podcast. The only one I own is Berkshire Hathaway.